Hello, and welcome to our fourth quarter 2015 strategy review. With me at the review were on my left, Len Skena, CEO and Vice President of the firm, and on my right, Bob Toomey, Head of Research and also a Vice President of the firm. We were also very fortunate to have with us Dean Amundsen. Dean is an independent registered investment advisory who specializes in bonds. And as you'll see as we go through the review today, bonds were a very important part of our discussions. Also, we had Scott Schill. Scott is not only my son, but he's also the firm's attorney. We haven't had a lot of need for Scott, but we're happy to have him, and we're very happy to have him at the review, again bringing on a different view from the outside rather than just us. There were three areas that we covered at the review today. Those areas were China, the recent action by the Fed, and the recent perception of volatility. I'd like to just put volatility a bit into perspective. Volatility certainly is there, but as the news commentators say, the market was down 100 points. I'd just like you to keep in mind that the Dow Jones average down 100 points is only 0.61% at current levels. If they use the Standard & Poor's, which is a much broader based index representing 500 stocks, it would have said the market was down 10 points. Now, of course, 10 points doesn't make news. But even keep in mind if they say 300 points, that's still less than 2%. There is another measure of volatility out there, and it's called the VIX. And we have that chart on your screen now, and you'll notice that the VIX recently did pop up to a level of 40. However, in the last 10 years, the VIX has been over 90. So this level is not that extreme by any means, and currently it's back down to its norm in the 20 area. Also recognize the VIX doesn't represent anything other than volatility. It's not either good or bad. As a matter of fact, as you look at that chart, when it was up over 90, that was just about the bottom of the markets back in 2009. So again, just make sure you understand volatility is not necessarily a bad thing, but one that we certainly want to make sure that we're aware of. With that, I'd like to turn it over to Bob to talk about what happened at the Fed and what that means to the stock market and other investments.
Thanks a lot, Stan. So as I'm sure many of you are aware, if you follow the financial news at all, you'll remember that last week the Federal Reserve was highly anticipated to raise interest rates, and as it turned out, following their Thursday meeting, they decided not to raise interest rates. And that took a lot of people by surprise. The reasons why we believe the Fed did not raise interest rates was primarily their perceptions of global growth, which they feel is not going to be as strong as they may have previously expected. A lot of you know that the news coming out of China has been mixed, if not considerably weaker. There's concerns about that. There's concerns about how rising interest rates might affect the competitiveness of U.S. exporters. So there were a lot of reasons why we think the Fed decided not to raise rates. The problem with that in terms of stock investments is that it has an impact on corporate earnings. Corporate earnings are a key driver of stock prices, and if investors believe that global growth is slowing, this could have a negative impact on earnings growth, and I think that's partly why we saw the very sharp reaction on Friday. The other concern, I think, for investors is, does the Fed know something that we don't know? And that, I think, was also reflected in the sharp reaction we had on Friday. I think in general that earnings expectations are probably going to come down a little bit, but I think that a lot of that is already discounted in the market. So the question is, we're talking about volatility. Is there more downside for the stock market here? And let me just put it this way: it's always possible, and I think that downside tends to be more associated with higher levels of volatility. But again, it will depend on expectations for growth. It will depend on the data that we see with respect to the economy. And I think we have very poor visibility into China. And really, as Len's going to talk about a little bit later, the data that comes out of China is very unreliable. The good news is we think the U.S. economy is going to hold up. We think it'll be just fine. We do continue to believe we're in this sort of new normal paradigm with 2.5% GDP growth. And we think that that will continue. We did reduce our equity exposure as a result of our deliberations. We reduced it about 5% on average. And again, it was primarily related to our concerns over increased volatility and our need for, our belief in our need for managing risk in portfolios. With that, I want to turn it over to Len, who's going to talk a little bit about fixed income and some of our changes there.
Thank you, Bob. We talked a lot about bonds in this meeting. As Stan indicated, we had an extensive discussion. It's actually becoming a little bit commonplace because interest rate has been the main subject of the talk for the last several meetings. But I do believe that in this particular meeting, we reached a couple of very, very important conclusions, and we changed our strategy slightly to accommodate those. First off, I'd like to just explain why it is so important to know what interest rates are going to do. If the Fed is going to raise interest rates, it is going to do that on the short end of this, the overall bond spectrum. And so short-term bonds are going to go up. Long-term bonds oftentimes follow, but it's not necessarily a given that they will. And we've been anticipating something in the way of a flattening of the curve rather than an increase to the entire spectrum. With the Fed not moving recently to raise rates in this most recent meeting, we discussed the idea that it's quite possible that the Fed will raise rates in the coming quarter. But if they do, they're probably only going to raise it maybe one time and wait quite a while and see how things go. It's not going to be, in our view, a very prolonged period of steep increases by any means. And so what we've chosen to do now is allocate not so much for a rising rate environment as for a low rate environment. So we have normalized our bond exposure, and we are emphasizing long-term bonds as much as we are emphasizing intermediate-term bonds right now. What we are not doing, though, is ignoring short-term bonds. We still believe that short-term bonds, should the Fed raise rates, are an opportunity for us to be able to turn over our holdings quickly and take advantage of those rising rates. And so we are over-allocated right now to short-term bonds and at normal allocations on the other side. I'd like to turn it over to Bob now to talk about our changes to equities.
Thanks, Len. So as a result of the discussion and deliberations, we did, as I mentioned earlier, reduce exposures to the equity sectors. We reduced our exposure in the large cap sector by about 6%. We reduced exposure in developing equity by about 5%. And we reduced international exposure by about 10%. But within these sectors, we did do some repositioning of some of these investments. We primarily increased our weightings towards growth stocks, particularly in the large cap area, but in really all three of those sectors that I mentioned. And the reasons for this are because we believe that growth stocks can have the ability to show stronger earnings growth. We think in a slow economic environment that stronger or faster relative earnings should result in better relative performance of those stocks against value sectors. I would also point out that if you look back over the last 5 and 10 years, growth stocks have significantly outperformed value stocks on a total return basis. And we believe, at least in the short term, that that probably will continue. I would also mention that growth stocks tend to maintain a higher valuation, largely because of their perceived growth and stronger growth in earnings, and if there is in fact some readjustment of valuations in equities here over the short term, which I do think is possible, even though I don't think that equities are rich by any means at 15 times earnings. I do believe that if in fact we do see some reduction in corporate earnings growth, that could result in a little bit further downside move, or if you will, in what investors will pay for stocks. I don't see it as being major, but I do see it as potentially a risk out there that could play into this volatility that we've been talking about. But at any rate, we believe that growth stocks will maintain a higher relative valuation if there is in fact some degradation of valuations for stocks across multiple sectors. So with that, I will turn it back to Len, who's going to talk about our international exposure and some of the changes there.
Thank you, Bob. When we're talking about international, there are a few different areas that we're focusing on. The big headline area right now is China. We're going to talk a great deal about that. We certainly talked about that in our meeting. And one thing I want you to keep in mind when you hear about what's going on in China is that China's impact on the U.S. economy is very, very small. When we hear about what's going on there, it's much more of a concern from an emotional standpoint for the U.S. than it is necessarily from a pure economic point of view. The rest of the world is frankly growing in a relatively slow rate. The U.S. is growing slow as well, and we're the best of a bad bunch right now. If you look at the overall places to be, U.S. is stronger as an economy than just about anywhere else. And so from that point of view, while we are reducing our equity exposure in the U.S., we're reducing it a little bit more internationally than we are reducing it anywhere else. But because of what's going on in China, we are avoiding China like the plague. We've been doing it for a while. We will continue to do that. One of the problems with China is we don't really know just how bad the situation there might be. The information that we get out of China is not at all transparent. We just don't really know what is going on. And so the measures that they've taken to date may end up just being a Band-Aid to something that might require something more in the way of somewhat significant surgery. We just don't know. To that end, the areas that are going to be more impacted if something significant does happen in China from here are going to be the emerging markets, and we continue to avoid them as well. One area that is impacted by what's going on in China is the natural resources sector. And so we have reduced our allocations there to well below normal levels, and we continue to represent it with wood, with basic materials, and with energy, and we just are below what we would be with a normal allocation under other conditions. With that, I'd like to turn it over to Stan for some closing comments.
Thanks, Len. As you can see, we are not negative on the markets. We're not negative on investments. However, we do recognize that there are some uncertainties out there. So we have reduced some exposure, and you will see some additional cash developing in your accounts. That cash, of course, does represent a reduction in the volatility of the portfolio. But keep in mind, your portfolios always have 9 investment classes, and only 3 of those are related to what most people consider to be the stock market, which of course is what gets most of the news. But also bonds supply a lot of income, and of course income is important to those clients of ours who are using that income. So with that, I'd like to say again, thank you for tuning in, and we'll see you next quarter.